Hey, what's up, everybody? It's Doug Shoemaker here with the Shoemaker Loan Team at Homestead Financial Mortgage, here with your weekly market update. Now, like always, I'm going to start with the Cliff Notes version for my friends who just want to know what time it is, and then we'll move on to how to build the clock for everybody who wants all the juicy details. And if you stick around for all the details, I'll also be sharing some rate lock or float recommendations from a couple of the country's most respected real estate economists. But let's go ahead and get to it. Job growth, it is stalling. The private sector, they lost 32,000 jobs in September. Now, the government shutdown, it's delayed the official jobs report. So the Fed's next move, it could get kind of interesting. Home prices, they're still up, but the rate of growth is actually cooling a little bit. Pending home sales bounced back nicely in August, thanks to, at least slightly to lower mortgage rates. And mortgage rates, they're holding in a fairly tight range. They're still historically at high levels, but they are showing some signs of easing pressure. So here's what rates closed at as of Friday based on national averages. The 30-year fixed rate was 6.32, the 15-year was 5.84, the 30-year jumbo was 6.25, the 30-year FHA was 6.03, and the 30-year VA was 6.04. Now, these are averages. They're based on someone being a first-time home buyer with a 25% down payment, 780 credit score, and the typical origination or discount fees. You really can't get an accurate rate without a full application where we can actually determine all your personal profile details so we can see what rate you qualify for. Now, there's no charge for this. I'm always glad to help, and I'll even share some secrets on how to improve your scores so that whenever you do find the house of your dreams, you get the best possible rate. Well, that's pretty much it for my friends who just want to know what time it is, unless you want to stick around for the lock or float advice in the end here. But otherwise, if you're finding this information helpful or you just want to make a local guy smile, please like, subscribe, share, and tell me about any other topics that you'd like me to make some informational videos on for you. Now, let's go ahead and start building the clock and look at what's really driving the numbers here. So, Case Shiller, the home price index, it's basically the gold standard for tracking national home values. It showed a slight decline in July after adjusting for seasonality. Now, nationally, prices are up about 1.7% year over year, and that's down just a touch from June's 1.9% pace. The FHFA index, it measures or focuses pretty much strictly on homes that are purchased with conventional loans. It also dipped a little bit month over month, but it's still up 2.3% annually. So home prices, they're still higher than what they were a year ago, but the speed of appreciation looks to be slowing a little bit. So if mortgage rates keep sliding lower this fall, though, we could see demand heat right back up and those prices are going to firm right back up as well. According to ADP, the private sector lost 32,000 jobs in September, and that is way off their expectation of a 50,000 job gain, and basically an 80,000 job miss based off of their original expectations. So even August got revised from a small gain to a small loss in jobs. The job cuts were pretty broad. Small businesses were down about 40,000 jobs. Mid-sized businesses were down 20,000. Now, large companies, they added 33,000 jobs. It was mostly in healthcare and education. Wage growth, it cooled a bit. Job switchers saw 6.6 wage growth, and that's down from 7.1% that it was at before. Now, job stayers, they gained about 4.5%. So clearly, housing is slowing. And as ADP's chief economist put it, employers are cautious. So the private sector, they've now seen losses in jobs in 3 of the last 4 months. So the government shutdown means that we're not going to get Bureau of Labor Statistics jobs reports, and we're not going to get the weekly jobless claims data. And both of these things are pretty much key indicators for the Federal Reserve. Why would that matter? Well, because the Fed just cut rates on September 17th, citing rising downside risk to employment. So without fresh government data, the Fed's going to have to rely really heavily on private reports like ADP's gauge of the economy ahead of its October 29th meeting so they can get an idea what they're going to do. Now, look, everybody, I might be sounding like a broken record this year, but remember, the Fed does not set mortgage rates directly. It sets the short term Fed funds rate, which is basically the rate at which banks are borrowing money from each other. Mortgage rates are actually influenced by the broader bond market and investor expectations about future inflation and growth. So job openings, they ticked up slightly in August to 7.23 million, but that's way down from the 12 million peak that there were in 2022. Now, both the hiring rate, which is at 3.2%, and the quit rate, which is at 1.9%, they're both near decade lows, which tells us two things. One, companies, they're not hiring very aggressively. And two, workers just aren't confident enough to job hop. Now, the ratio of job openings to unemployed workers, it's dropped from two openings for every one unemployed person in 2022 to just under one job for every one person unemployed now. And that is a major shift showing how much the labor market has actually cooled down. Now, there is some good news in housing. Pending home sales, they jumped 4% month over month in August and 3.8% year over year, according to the National Association of Realtors. And these are signed contracts, not closed deals. So they're actually an early signal of what's coming. And the rebound lines up with the dip in mortgage rates that we saw in late summer. That also means that we could see even stronger housing numbers in upcoming reports. So, hey, everybody, this week I want to share with you one of my all time favorite desserts. It's called sticky toffee pudding. And a good friend of mine introduced me to this years ago at Schlafly, downtown St. Louis. I don't know that I've stopped thinking about it since. This stuff's more like a cake than a pudding. Who cares? It's incredible. If you're not licking the bottom of your plate, well, maybe not the bottom of your plate. If you're not licking this greatness off your plate at the end, I'm not sure we can be friends anymore. But anyway, check out the full description down below. I found a recipe that is actually for the Schlafly version of this stuff. And if you decide to make it, I'd love if you send me a picture or I don't know, send me the whole cake. Anyway, let's go ahead and get back to it now. With the shutdown still on, don't expect a whole lot of new economic data. We're going to get home price appreciation data from ICE and CoreLogic, but jobless claims are likely going to be delayed still. Now, the technical outlook looks cautiously optimistic for this week. Mortgage bonds, they're holding their gains. The 10-year treasury is kind of flirting with the 4% target. And if it breaks below that, we could see a little bit more breathing room for mortgage rates. So, the rate lock or float recommendation I have for you all this week, if you're closing within the next 2 weeks, I'm going to give you two recommendations right now. One, if you are a person of very low risk tolerance, I would just consider going ahead and locking right now. It's a much better rate than what we've seen in the last few months. I would get that thing locked. You're probably going to have a refinance opportunity come up in the next year or so. So I don't believe there's a lot of risk there for you. If you've got a high risk tolerance and you like to just go to the last second and make sure you get the best you can possibly get, as long as you've got a really strong relationship with your lender and you know that they actually know what they're doing when it comes to the stock market, the bond market, how mortgage rates are calculated, just make sure you're in really close communication with them. If you're closing 2 weeks or further out, I would say let's just keep that thing floating for right now. Well, everybody, this wraps up this week's update. If you found this information helpful, please like, subscribe, share it. It really does help me continue creating this information. And if you're a first time home buyer, a local hero, or a current homeowner looking to refinance, or purchase, the Shoemaker Loan Team and the Home Foundation, we're here to help you every single step of the way. I'm Doug Shoemaker. Thanks so much for watching, and I'll see you next week.